Good morning, everybody, and welcome to this is the second Banking Risk Academy week with Deloitte. I hope the next one we manage to be in person as well. Yes. I will make a quick introduction about the week and today's session, and a little bit of housekeeping rules. And then we jump into today's panel. Yes, so if we could move to the next slide, please. So due to the success of our first week, we decided this time around to double it. Yes, so we have 10 sessions in 5 days. We have more than 30, I see 34 subject matter experts from Deloitte, yes, coming, representing more than 10 countries, yes. So the intention for us was to bring a wide panel of experts, yes. Today we have 2 sessions. The morning session about the regulatory and the supervisory agenda, and the afternoon session about capital management and stress testing in the post-COVID era. Yes, I will quickly introduce today's panel before we jump in the subject. If we could move to the next slide, please. And the next one, thank you. So together with us, I have to say I'm biased towards this session. It's my favorite. It's sort of an umbrella of our understanding about the regulatory and the supervisory agenda, which seems to define a lot for both the banking professionals and the professional services firms like us. Yes. So together with us, we have Simon Brennan. He's a director with the risk advisory team. He's based in London. And he represents today the EMEA Center for Regulatory Strategy. We have Stéphane Touet. He's a director with Audit and Assurance team in Germany, and he represents the Banking Union Center in Frankfurt. Yeah. We have Steven van Honecker. He's a director with Risk Advisory as well. He's based in Brussels, and he's our go-to expert when it comes to recovery and resolution. And last but not least, we have Michael Cluzet. He's a director with Risk Advisory in Germany, and he is our go-to expert when it comes to Basel. Yes. Thank you all for being today. I will pass the torch to Simon. Yes. We have limited the duration of our sessions. Yes, so they're easier about everybody's schedule. That's why I'm rushing a bit in. Thank you, Simon.
Thanks, Dimitris, and good morning, everyone. So in Deloitte's Financial Markets Regulatory Outlook, which we published in January, we identified a number of themes affecting financial services firms. 6 months on, the economy and the financial services firms in Europe are faring better than we expected. Successful vaccination programs and a progressive easing of lockdown in some countries, along with continuing government support measures, appear to have mitigated the economic fallout from the 2020's severe economic contraction. But significant challenges remain. A multitude of factors: inflationary pressures, potential monetary tightening, the possibility of asset price corrections, heightened debt servicing costs, lingering household fragility, and the delayed onset of corporate insolvencies all present financial services firms with a challenging environment and ensure that there will be continuing pressure on capital positions. So this is the backdrop against which I want to review the regulatory outlook. But before I start, let's begin with a quick poll question to check everyone's listening well. So what I want you to consider, and just consider this carefully in terms of what the biggest issue is from your perspective. So which one of the following statements best describes how you feel about the regulatory change over the next 12 months. So first off is addressing new regulation will dominate senior management time, i.e. regulation continues to be a significant drain on your resources. The second option is that the complexity and uncertainty of regulation are the biggest concern. So what I mean here is that it's not so much that there's a lot of regulatory change, but it's more that it's more complex and more uncertain than it's been for a while. The third option is new regulations are going to, what you're most concerned about is new regulations are going to limit your ability to innovate. So actually it's less a compliance problem now, but it's more that regulations are constraining your ability to run your business. And finally, perhaps you think that actually regulation is not the biggest deal. It's going to be navigating economic challenges that are the main concern over the next 12 months. Let me just give you a few more seconds to submit your responses. But really, from my perspective, all of these options are in play. If I think back in the last 10 years, post-financial crisis, it was the volume of regulation that was clearly the problem. And many of those regulatory changes were most immediately problems for risk and compliance. Regulation hasn't eased, but the regulatory change perhaps has slowed a little bit. And certainly we're seeing now more regulation aimed at what you could say is the kind of commercial side of the business, the technological innovation and the climate change agenda. So maybe we can stop there. Could we go to the results of the poll, please? Okay, so that's really interesting. Thanks everyone for submitting your responses. I think any of these outcomes could have been possible, but I think it's interesting that half of people are most concerned about complexity and uncertainty. With the other categories still important, but not much so. And I think it's actually in this environment where regulatory strategy is most important. So getting on the front foot, understanding what is coming down the track, because that gives you the best opportunity to understand how different regulations fit together and how some of that complexity can be tackled. Okay, well, can we move on to the next slide, please? Let me share with you. It's the one before that. Could we move back 2 slides, please? Perfect, thank you. So let me share with you a quick overview of what I think some of the biggest risks, biggest regulatory themes are, and this really sets an agenda for what the rest of the week is going to cover. So first off, on financial resilience and business model volatility. So over the next half year, the capitalization of the banking sector, sorry, over the past half year, the capitalization of the banking sector has actually improved on average. That's partly because the significant decline in credit quality that was predicted to follow the pandemic has not yet materialized. And that in turn is due to the extension of government support schemes and payment deferral programs, and also a legacy of the restrictions on dividends that was in place last year. It remains unclear how the post-COVID business landscape will compare to that which prevailed pre-pandemic. But there's a lot of concern that some sectors are going to be particularly affected. For example, changes in working practices may mean that there is less demand for certain types of insurance. The ECB in its May financial stability report listed several sectors that it considered more vulnerable, with services sectors in general regarded as less secure than industrial and manufacturing sectors. So all these considerations are going to play into credit quality in the next 6 months. And we see, if we think about the ECB leadership team, including Andrea and Ria, a real focus on thinking about whether banks are really getting ready for tackling the non-performing loans that are potentially going to come down the track. The other kind of thing that flows out of this concern about changing economy, changing world of work, is that it's another weight on the pressure that firms have, financial firms, services firms have, to address long-standing challenges to their profitability. As you know, consolidation has been a long-running theme of the ECB, and again in recent weeks we've seen the leadership team talking about that. What should banks do about this? Well, continue to build capabilities to deal with higher volumes of retail and business customer distress is certainly a key thing, and there's a possibility of exploring how automation or new technology could support that. And then more generally, just being on top of the changing credit risk environment. Early and accurate identification of credit risk deterioration is key, and we expect supervisors are going to be increasingly looking at banks' capabilities in these areas in order to ensure that we don't have an unmanaged build-up of credit risk. The second topic is sustainability. And actually, if I think about my personal time, this is a topic that's really dominated the last 6 months. There's a lot going on. New requirements from the EU in relation to ESG disclosures, including on the taxonomy, corporate reporting and bank disclosures, have brought some clarity to what's going to be expected, but have also underscored the complexity of the reporting framework that is being developed. In advance of COP26, we can expect continued focus, both government and regulatory, on how financial services industry is going to respond to the net zero challenge. And over the weekend at the G7 meeting, we saw a further reinforcement of the commitment to the transition to net zero. So that's on reporting for kind of climate risk. We're also expecting an increased focus on biodiversity. You'll be familiar with the TCFD, the Task Force for Climate-Related Financial Disclosures. Last week, we saw the launch of the TNFD, the Task Force for Nature-Related Financial Disclosures. And within the environment risk bucket of ESG, biodiversity, ecosystem degradation are as important as climate risk. And we expect increasing focus from supervisors on these areas. From a requirements perspective, probably that's not going to affect you in the next 12 to 18 months. But banks are already building new data boxes, new collection systems, new risk processes to manage climate risk. And it's probably timely to consider how nature risk should also be factored into those systems. Probably the question I get asked most about in this space, though, is around capital requirements for ESG. Where supervisors have offered an opinion recently, they've reiterated their position in favour of solely risk-based approach to setting Pillar 1, i.e. we continue to set Pillar 1 based on credit, market, liquidity, operational risk. And climate risk or all ESG risks should kind of inform those risks. We expect that to remain their position, but there may be political pressure to introduce in future explicit risk weights for climate risk. All that said, climate should already be considered as part of the SREP, albeit as part of a qualitative factor. In terms of Pillar 2, more generally, we are seeing increased interest in stress testing. The French regulator, the ACPR, finished an exercise earlier this year. And with the Bank of England has just, in the last week, started its climate risk stress test for the largest UK banks and insurers. But in both cases, those stress tests are focused not on setting capital, but on understanding risk exposures and on understanding banks' capabilities to manage those exposures. So currently, we're not seeing, even either in the Pillar 1 space or the Pillar 2 space, an explicit drive to set capital requirements as part of, to set capital requirements based on climate risk. The third topic that we called out earlier this year, which remains very relevant, is operational resilience and digitization. COVID-19 was a significant stress of operational resilience capabilities, but supervisors have been clear that it wasn't severe enough. COVID-19 in a way was beneficial, was easier for banks to manage because it was it had a sector-wide impact, so everyone was having to deal with it at the same time. And to some degree, the effect was certainly sustained, and it wasn't a very sharp and sudden change to the situation. I.e., we had to move to working from home, but we had a few days to move to that situation. Supervisors are concerned about banks' resilience to idiosyncratic and very severe operational disruptions. And we've seen those already in other sectors, for example, through ransomware attacks, where organizations have lost access to data instantly. And supervisors want to understand what the resilience is to those sorts of situations. There's a significant piece of legislation in the EU. It's called the Digital Operational Resilience Act, DORA. That's progressed rapidly through political negotiations, and it's possible we'll see a financial agreement at the end of this year. Key to watching that is the design of requirements around critical third-party oversight. So to put this in practical terms, are there going to be new powers to oversee cloud service providers directly, for example? that would have a significant effect on the responsibility of banks in terms of supervising third parties. There's also currently a 12-month implementation period for the ICT risk management provisions, which is not a long time. So if that 12 months is retained, banks will not have a significant amount of time to comply with these new requirements. Closely connected to operational resilience is digitalization. With regards to digital payments, supervisors are concerned about the increasing complexity of the payments transaction chain and the involvement of non-bank payment service providers. So there's more scrutiny on financial resilience, reliance on outsourcing, and the regulation of those third parties as parts of the payment activity. As you're probably aware, the EU also continues to develop its regulatory framework for crypto assets. We also saw a paper from the Basel Committee last week on prudential treatment of crypto. And as a regulatory focus on AI continues to grow, the EU has developed an AI Act, which is not financial services specific and has quite a broad reach potentially. So there's a significant activity there. And this is one of the topics that led me to think about that question around, is regulation actually inhibiting your ability to innovate as a firm? Because technological innovation drives ahead regardless of regulation, but the regulators are seeking to get their hands around it in order to check it's resilient, and that may be a drag on your ability to innovate. Just quickly through the two topics at the bottom. On conduct and culture and governance, this remains key. I think in the context of COVID, one of the things that's a particular concern for supervisors is ensuring that the treatment of customers in distress is okay. And banks are going to need to think about training and record keeping to ensure that as customers in distress contact them or are dealt with, they're treated fairly. The potential volume of customers means that might be potentially a challenge. Separately, but as importantly, the ECB is also making a push around board diversity. Andrea and Ria spoke about this 2 weeks ago at a conference and underscored the fact that board diversity in particular is important to setting the right tone from the top of an organisation. And we're expecting the ECB to spend more time over the coming months assessing, including diversity in the assessment of candidates' fitness and propriety. And finally, on financial crime, so European policymakers are intensifying the fight against money laundering. In May, the European Commission outlined proposals to create a single AML rulebook, likely through an AML regulation, and an EU supervisory body, and enhanced coordination of data sharing between member states. So AML is not new to the regulatory agenda, of course, but we see this continued ratcheting up of scrutiny. And over the next 12 months, we're also going to get a better idea of how the EBA and the ECB are going to take AML into their prudential responsibilities. Of course, AML is not at its origin a prudential issue, but for reasons that we're familiar with, there's now a clear expectation amongst policymakers that the Prudential Authority does take some responsibility for the prudential consequences of AML risk. And finally, just to wrap things up, I've got 3 topics on the right-hand side. Recovery and resolution planning and prudential capital requirements remain very important. They're very familiar, and we're also going to talk about them through the course of the rest of this presentation. First with Michael and then with Stephen in the Q&A. The transition to the end of LIBOR and IBORs more generally also remains on the cards. But again, there haven't been that many developments. It just remains a key deadline that banks need to manage to. From the LIBOR perspective, the UK authorities have underscored that LIBOR will end at the end of this year, and there's increasing effort to deal with that. In terms of IONA, that will be discontinued from January 2022 and replaced by the new Euro short-term rate. So that transition is happening and is something banks need to manage. So that was a whistle-stop tour of the regulatory horizon. I hope I've whetted your appetite for the rest of this session and the rest of the week. If you have any questions, we'll pick those up in the Q&A session shortly. But for now, I'll hand over to Michael to talk about prudential capital. Michael.
Yeah, thank you, Simon. I was quite impressed with the outcome of the question that the poll that was raised, and the top answer you gave was uncertainty, and I think uncertainty also fits very, very well when we talk about the future of own funds. We know that the Basel Committee has decided upon a complete revision of capital requirements, and we know that the European Union and other regulators will respond to it. But we're still waiting for the Commission proposal how to adopt those changes in the European Union. So there's a bit of uncertainty in it, and definitely there also is some complexity. So let me just start by having a quick look at what exactly we are talking about when we speak about Basel III. Basel III was a response of the regulators to the financial crisis that we saw some 10, 12 years ago. And in the first step, that's what everybody has in mind when talking about Basel III, was refining own funds, what is acceptable as own funds, what is core equity tier 1, additional tier 1, what is tier 2 capital, and how much does a bank need. The risk weights, apart from securitization and a quick fix for market risk, weren't really touched. The regulators took time and did a number of impact studies, proposals, and so on to also revise the capital requirements basically for all types of RWA that we have. For counterparty credit risk, securitization, and market risk, the Basel Committee came to a conclusion at a rather early stage. So this is what was available a couple of years ago and what the European regulators turned into the CRR2, the second version of the capital requirements regulation. But a number of topics were still open at the Basel Committee and could not be fit in CRR2. And these are the topics that we expect to see in the CRR3. So that's a revision of the standardized approach for credit risk, modifications to the internal ratings-based approach for credit risk, changes to CVA risk, and a completely new approach for operational risk. And then we also expect the capital floor that the Basel Committee has proposed, meaning that all banks using any sort of internal approach will need to calculate the standardized approach in parallel, and the benefit of internal models will be limited to 72.5% after a phase-in period, 72.5% in relation to the capital requirements that we would see under the standardized approach. So there's a different wording for the remaining changes. Consultancy firms like to call it Basel IV, just to demonstrate that it's another step forward from Basel III. The regulators themselves call it Basel III Final. The British regulator has dubbed it Basel 3.1, but basically it's all meaning the same. These are the changes that we expect to RWA calculation. On the next slide, we see an overview of all the various approaches that are available. And for credit risk, at first sight, the changes are not so significant. We still have the standardized approach for all risk types for all portfolios. We still have the IRB, the foundation IRB, and the advanced IRB. But we will see a few modifications. For those portfolios where it is difficult to model LGD and CCF, mainly because we see very little defaults, the advanced IRB will no longer be available. For those portfolios, banks will be required to revert to the foundation approach. The Basel Committee has not decided upon the advanced IRB for sovereign exposures. Strictly speaking, they have not decided on the future of how to treat sovereign exposures at all. But my personal opinion is that it's very unlikely that the advanced IRB will remain available for sovereigns if it's mandatory to revert to a foundation approach for banks and large corporates. So that is just my personal interpretation. It's not official. We will have to wait and see for the CRR3 proposal whether the advanced IRB remains available for sovereigns or not. For equity exposures, the Basel Committee has been quite clear. All equity exposures will be treated following the standardized approach rules. So there's no choice then. For the other exposures, all choices remain available in the credit risk segment, but please be aware that especially in the standardized approach, the new standardized approach becomes much more risk sensitive. So we will see banks with an increasing RWA figure, a total RWA figure, and we will see banks where capital relief is to be expected. The Basel Committee has conducted numerous impact studies, so has the EBA, and the main message is that the outcome was very volatile. Some banks expecting a relief, as I said, and some banks expecting up to 40% more capital requirements. So if you haven't done so, please make sure that you do a calculation concerning the future RWA under the new rules no later than when the CRR3 proposal comes out. So for securitization, we saw the changes at an earlier stage. The new framework is already in place in the European Union to be adopted since early 2019 for new securitization exposures and starting last year for all securitization exposures. Counterparty credit risk is part of the CRR2 in the European Union, so these new rules become applicable at month end. And the Basel Committee has a standardized approach and the internal model method. The European Union added 2 additional approaches to make it more feasible for smaller banks. The original exposure method remains, and we have a simplified standardized approach for smaller banks, again, where counterparty credit risk is not a significant part of the portfolio. For CVA, we have in the future 3 different approaches, one based on the CRR charge, just a multiplier. Then for those where CVA risk is more important, we expect a basic approach and a standardized approach. All 3 of these count as standardized approaches in the sense of the output floor. For market risk, it is part of the CRR2, so we know how to do the calculations, but it will be a reporting requirement only. And we expect the capital requirements to become mandatory by 2023. That's the date the Basel Committee has chosen, but this is still subject to change if the European politics should decide to do so. The original Basel approach has an internal model-based approach and a standardized approach. For the European Union, we also have an alternative approach for both standardized internal model to make it applicable also for smaller banks. So we have a question from the audience: what does IRB mean for retail? In retail, today we have no distinction between the foundation approach and the advanced approach. So banks using the IRB approach for retail should also estimate not only the PD but also LGD and CCF. But the rules to obtain these figures are simpler. And as I said, there's no distinction between foundation and advanced, so it's one approach for the entire IRB. Okay, ultimately, we have operational risk. As of today, we have 4 different approaches: a very simple basic indicator approach, and then it gets more and more complex, and the most sophisticated one would be the advanced measurement approach, where banks are required to calculate capital requirements based on an internal model for operational risk. All existing approaches will be abolished under Basel IV and replaced by a standardized measurement approach, which combines balance sheet and P&L information that we today see in the standardized approach and the basic indicator approach. And it also includes the loss history, the individual loss history of a particular bank. The Basel Committee says that the loss history shall only be binding for banks above a certain threshold, but what we hear from Basel is that it is quite likely that all banks will be required to include the individual loss history, or to at least open it for all banks, so that those banks where the track record, the loss history is advantage, that they can then use the bank's internal loss history. All in all, as I said, the standardized approaches will become more risk sensitive. Some of the internal models, AIRB or operational risk, will no longer be available. This means that the general process to determine RWA will be modified. Pillar 2 will remain to be in place, so banks will be able to demonstrate to the regulator as part of the ICAP that they are able to estimate the risk with good quality. So simply switching off the internal models is not to be advised. If the internal approaches aren't satisfactory for the regulator, via the SREP, you could expect surcharges. So this could end up in additional capital requirements. On the next slide, we have a short timeline what to expect in the European Union. I already briefly mentioned that the CRR2 will become applicable from month end on. So co-rep reporting as of 30th of June will be subject to the new rules. So we have the leverage ratio, NSFR, the new standardized approach for counterparty credit risk, modifications to large exposures, TLAC, and central counterparties. All that becomes applicable now. And when planning this risk academy, we also expected that we would already know what the CRR3 looks like. Originally, the Commission proposal was expected for last year. Then COVID-19 came on the table, the priorities changed, and the regulators decided to postpone the CRR3 proposal. We were hoping to see it before the summer break, but we hear from Brussels that they need a bit more time. They most likely will not be able to finish the consultation on the CRR3 proposal before the summer break. So it now appears likely that we will see the draft of the European Commission late third quarter, early fourth quarter, so probably September, October. We do not yet know how long the political negotiations in Brussels will take. For the CRR2, it was 2.5 years. So that could mean that by end of 23, early 24, the whole package has been agreed by Parliament, Council, and Commission. Please keep in mind, we have an election for the European Parliament in 2024. So the negotiations must be complete by then. Otherwise, they would have to start all over again. And for CRR2, that was also a bit of the rush at the end, just to make sure that they meet that formal deadline. What we also do not know is how long the implementation period that the politics will grant the banks will take. For CRR2, it was 2 years. So if we assume something between 1 and 2 years, the earliest that I personally think is realistic for the political conclusions in Brussels would be late in 2022. Adding 1 year for implementation means that it's very unlikely that we see the new rules come into force before end of 23, early 24. More likely is sometime in 24 or probably even later. Because of COVID-19, the Basel Committee has postponed the date of entry for Basel III final from 23 to 24. But as I said, it's very, very unlikely that the European Union will meet these deadlines. And to be very frank, all other regulators, except from Singapore, haven't published their proposals so far. So it looks like no major jurisdiction will meet this deadline. Okay, we have prepared a few questions on this topic. So if you could move on to the poll. And the question is, your institution, how are you dealing with it, or have you already started dealing with Basel III? Do you intend to do so no later than this year, or do you start no sooner than 22 or 23? As I said, the regulators are still working on the proposal on what Basel III final could look like in the European Union. On the other hand, many, how shall I put it, many standards are pretty clear. My personal expectation is that modifications that the European Commission makes in comparison to the Basel original will be more on the details, but not on the general approach. And topics such as the output floor will not be touched at all. The regulators are, as we hear it, discussing on how to apply it in detail, but it's not a question of whether or not we will see the output floor in the European Union. So based on that, we definitely believe that banks should get started to make the best use of the remaining time. So let's see what the outcome of the poll is. And I think that's quite interesting. 1/3, roughly speaking, say you have already started. 20% say that you will start no later than this year. So that's half of the audience expecting to start no later than end of this year. Then others plan to start in 22. And for some of you, it's even later than 23, roughly 10% who don't expect to start very soon. Okay, thank you. And as I said, we advise to not wait too long because of the complexity of the overall topic. Apart from Basel III, we also have other items going on in parallel. Some of them will mean capital relief, others will mean capital pressure. Capital relief, it's difficult to put it on a timeline, but the economic recovery from COVID-19 has already started to kick in. So it's quite likely that some of those boroughs which have been under pressure because of the pandemic will see some relief. Also, there are still the government guarantees for several exposures which provide relief, and until end of next year, banks are allowed to add the IFRS 9 impairments back to capital. On the other hand, we know that during this year, the COVID-19 moratoria will end. The IFRS 9 impairments from stage 1 to stage 2 and from stage 2 to stage 3 will increase, putting capital pressure on both risk weights and the available capital relief. And then after 22, the reversal of the transitional relief will kick in, so the capital base will deteriorate. And then, as I said, the Basel Committee expect Basel III to kick in 23, 24, 25 is probably more likely for Europe, but we expect for the majority of banks that the capital requirements will increase, so that puts additional pressure on the capital base. On the next slide, we see a rough overview of why it is advisable to start with the implementation planning of Basel III at an early stage. The picture in the middle basically refers to the calculation engine. I don't want to go there in detail, but there are a few considerations which I would like to touch upon, like business strategy, the need to rework some of the systems, data availability. To do the calculation for the standardized approaches, you will need information that you probably never captured in the front office system. So you need to find out whether the data is available or not, and if it's not available, what is the best process to capture that. Data quality will also play in there. And then because of the new rules, the collateral optimization rules that you may have will have to be redesigned. On the other hand, we have the downstream considerations, the regulatory reporting and also management reporting will need to be updated. We will say some interaction with IFRS 9. Pricing should be mentioned. Just as a quick reminder, the capital requirements will change, so the capital charge will change. This is a lose-lose situation, because if capital requirements go up and you didn't consider that in the pricing, you will not earn the full capital premium. On the other hand, if capital requirements decrease and it's not reflected in your pricing, then you probably earn nothing, because the competitor might be able to come up with a better rate, and your client signs with the competitor. So many considerations due to time constraints. I will not go into the details here. Let us have a quick look at the remaining slide. That's about the implementation planning. A few key takeaways. If you just wait for the final rules from the Basel Committee, you will end up with probably 2 years, probably less time to implement it. So it's really advisable to start the implementation at an early stage, identify the IT systems that need to be updated, missing information. If you are subject to the capital output floor, this will mean additional capital requirements. You need to allocate it in terms of pricing, in terms of capital management. This will require strategic management decisions. And that's really independent of whether we see a particular risk weight for a particular product. These are general considerations. And as I said, once we know what the exact CRR proposal will look like, it's time to kick off the project. The Commission proposal will not be 100% identical to the final rules, but as the history has shown, in most cases, it's mainly about the details, not the overall approach. So that shouldn't stop you from kicking off the project. So that's just the rough outlook on capital requirements.
Thanks very much, Michael. A lot going on. So if I can I ask the rest of the panel to join, and we'll conclude this session with some a panel discussion. If you have any questions, please feel free to continue to add them through the Q&A, and we'll I'll pose them to the panelists over the next few minutes. So Stefan, maybe I can start with you. So I mentioned in my remarks that ECB has highlighted a number of risks, including on NPLs. That would normally imply a kind of uptick in supervisory activity, but of course over the past year, COVID restrictions have limited the investigatory work that can be done. What should banks expect now in terms of OSI, IMI, AQR activity in the months ahead? And does the ECB have the capacity to do more?
Well, in fact, we are looking back at a year of offsite inspections, or no inspections at all. The idea of ECB was that they wanted to be part of the solution and not part of the problem, and they considered the banks as well as being part of the solution and not part of the problem, in this case, in the specific COVID situation. So since March, pretty much last year, there were no activities in terms of on-site inspections going on. Still, the risks are there. In fact, the risks are increasing. And in December, Andrea and Ria sent out this letter to the banks asking for self-assessments in terms of the handling of credit risk and credit risk management, announcing in detail that this might be followed up by on-site inspections. So just looking at COVID, I would expect here a significant increase in on-site inspections. The main question is when it will start. Will it be already this year, or is, as announced by ECB, 2021 considered as a year of recovery? The biggest fear is clearly the cliff, that when the moratoria are expiring, that suddenly there's a wave of NPL increase coming in. So ECB at this stage is looking and assessing the situation, looking at risks at banks, making selections. But yes, there will be more on-site inspections to come, and I would expect to see them at latest in the second half of 2021. Does the ECB have the capacity to run such exercise in a focused in a focused way on large scale? I mean, if we look at 2016 to 2019, when they were running the TRIM, they did over 200 on-site inspections in assessing internal models at more than 65 financial institutions. This was done with the support, partial support of external service providers. So if the ECB wants to run the campaign, they certainly will be able to do it. In case of doubt, they will have recourse to external service providers. The second part is pretty much AQR. I mean, this is a little bit a special animal. Anytime a bank is crossing the threshold, we've seen a couple of banking groups being formed. We had some Brexit banks joining the banking union. Clearly, there will be on-site AQRs going on. But as well here, if ECB decides to run this on a larger scale, they can have recourse external service providers, and it's a target of ECB to go back on site.
Okay, so there's this coming down the track. I mean, I wonder as well whether technology could play a greater role. Have we seen any evidence of the ECB thinking about supervisory technology?
Yes, ultimately it's all about data management and information management. And for now, it's still people business, this particular in on-site inspections. The teams are going in, are analyzing the documents. But even here, the handling of the data up front is becoming more and more important. They are running already now algorithm to check the data integrity and completeness. These questions will become more and more important. And I could imagine as well that this will be extended to data mining, text mining, things like that, to ease the work of on-site inspectors and regular day-to-day work of the JSTs. If you look at the needs and how ECB is acting currently, you can see that they are seeking currently external service providers to provide advice for these areas of supervisory technology, including artificial intelligence, things like that. So this will become more and more important and an increasing factor in day-to-day work of these teams, still with a ultimate remaining human factor. But my guess would be that banks are looking at more questions from the supervisors, which ultimately can be analyzed in an automated way.
And Stephen, maybe I can bring you in briefly here. So Stefan's just covered the ECB position, but do we see anything similar happening at the SRB in terms of technology?
Morning, everyone. I'd say, first of all, I think it's fair to say that SRB and ECB are in a different stage of development. So SRB being a relatively young organization, I think their focus is probably more on investment in core technology, so not yet looking into machine learning, AI, etc. That being said, BRRD does give the SRB some power. So some of you may know that the SRB is setting up an on-site inspection division at this stage. They have not made anything more public around that, but they are doing that. So I expect the evolutions we see on the side of ECB are to be seen at the SRB side as well at one point in time. maybe what is interesting, Simon, to add there is on the national level, I do see those same evolutions that Stefan mentioned. So both on as we see them on ECB side, I do see those at the national supervisory side as well. So the national supervisors are making a lot of investments at this stage, both on the side of AI, machine learning, the supervisory technology, as they call that, but also a lot of investments on more core IT services like cyber, like data portals, data protection, etc. So I think that's an interesting evolution as well.
And Dimitrios, maybe I can just ask you. So we've got this ECB SLB activity, but what does this mean for banks? Is subtech going to make life better or harder for them?
Yes, thanks, Simon. I think it's the new age. I think that the intention of ECB to go into remote data-driven supervision is nothing new. Yes, they're just building up on this, and I think that it touches on a very traditional challenge for the European banks. Yes, how to manage big data, and I think that it will be the time when they will have. I would say no other alternative, yes, to do for the banks to do patchwork. Yes, so I think it will challenge them a lot on finally optimizing to start with data management. Yes, so and that comes to data governance, that comes to hard infrastructure. So yes, I think that once it emerges as a new trend from the supervisory perspective, then it's going to be sort of an ultimatum to the banking sector on how to address the data quality issue.
And of course, we've got a session later this week on BIRD, so the bank's integrated reporting dictionary that the ECB is developing. Presumably that just fits into this bigger picture as well.
Yes, totally. I mean, it's another piece of the puzzle. Yes, about remote data-driven remote supervision. So the ECB sort of revolutionizing the whole reporting element. Yes, the communication with the banks, and I think that's also going to address legacy practices of the banks of how to derive reports or how to correct reports that come out of the system before submitting to the ECB. And I think that's going to be the main differentiating factor. Yes, that the bank will no longer have the ability, yes, to optimize report that comes out of the system. Yes, so this type of communication is going to become almost automatic. And I think this is going to be the challenge for the banks. Yes, how to fix the issue in the source rather than just treating the symptoms.
Thanks, Dimitrios. Maybe I can just change tack now and look at resolution planning. So, Stephen, you're close to what the SLB is doing. What are they focusing on at the moment? And do they think bank resolvability is actually improving?
Well, I think their clear priority is still data capabilities. I think that links with what Dimitrios said. They started there with the SRB expectations for banks, so they made data a priority. If you ask me whether this topic is still a priority now, I would say yes, still priority number one, although they've taken some actions over the years. So you're probably aware of the data self-assessments, the data capability self-assessment that the banks had to undertake. Most of the banks in Europe had to complete that exercise now, so the results are being analyzed by the SRB as we speak. They're probably making a horizontal exercise around it that is not gone. I think that expectations is still there, and if you come to think about it, I think SRB rightly made that their priority number one, because if banks need to produce that data on a 48-hour basis by the end of 2023, that leaves us with 2.5 years. So if banks need to make substantial investments in technology, that is typically the throughput time it takes to set up that kind of system. So data is clearly a priority. If you ask me, did resolvability improve? It's a difficult question to answer. I think SRB covered a lot of ground during the past few years. What is interesting to mention that as well, resolvability is something bank specific. So I know the SRB internally is also working on a heat map So they are trying to score the banks in terms of the resolvability they see, and they are planning to take action towards the banks based on that score. Resolvability is very bank specific, so it depends on business model and preferred resolution strategy. So it's not the easiest exercise, but let me maybe stop on that point. It's it gives the SRB a couple of angles to work with. So if you may have read the 2020 MREL policy of the SRB, they mentioned there that they can increase or decrease the subordination requirements of the banks depending on their score of resolvability. So that gives them a clear lever, I think, once they have the resolvability scoring of the banks in place to make a harder push on the banks to do their work and make themselves resolvable. So not a clear-cut answer there, I would say, Simon.
Okay, but that link to MREL is useful. I mean, Demetrius, maybe I can just ask you briefly, what do you expect in terms of MREL requirement implementation for smaller institutions? Is this ultimately going to drive M&A activity?
Yes, I think MREL applies pressure, yes, on the capital requirements, and I think on the capacity of the institution to accommodate such. And it hasn't been very different. I mean, Michael made a lot of reference to Basel and the pressure that's going to bring to the capital requirements. You mentioned a lot of the supervisory requirements that brings also a lot of administrative burden and operating expense. So I think that MREL is not something different than what we already mentioned. Yeah. So is there going to be additional pressure coming from both regulation and supervision? Yes. Could small or in some cases mid-sized institutions deal with it? I would put a question mark there. Yeah. So we have seen consolidation trends in the last 5 years. Yes. And I think that this is going to intensify. Yeah. I don't see a small institution being able to cope more.
Thanks, Demetrius. Michael, we're almost out of time, but perhaps I can give you the last word on these questions. You gave quite a very comprehensive picture of the Basel framework. I mentioned AML in my comments. How do you expect financial crime to be picked up from a prudential perspective?
Well, first of all, financial crime basically is a conduct topic, so it's not yet reflected in the prudential framework. On the other hand, any fine that the banks see will weaken the capital base. The fines are typically based on deficiencies in the processes and controls, so that's operational risk, and it will enter the operational risk loss database if such things occur. And then finally, the EBA has already announced that when reviewing the processes and controls that banks maintain with a view to financial crime and money laundering, they might impose an SREP surcharge based on these topics if they believe that banks are not working hard enough on detecting AML and financial crime. So there is some interplay, but this is still evolving, and we need to wait what the regulators come up with.
Thanks, Michael. Everyone, thank you very much for your responses. Demetrius, perhaps I can hand to you to close the session.
Yes, thanks, Simon. So we are already 1 minute above. It has been a very interesting session. I would like to thank all speakers and attendants. Shows that both banks and us are going to have a full plate. Yes. I would like to thank everybody and also remind the afternoon session on capital adequacy and stress testing. Yes. Thank you, everybody. Bye-bye.
Thank you. Bye.